Welcome back to another Zero DTE video, and today Ernie's going to talk about navigating different volatility regimes with the out-of-the-money butterfly, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to Ernie's course.
The out-of-the-money butterfly. The primary principle behind it is that, well, of course, it's zero DTE, so our objective is to try to take advantage, at least to some degree, the rapid premium decay of options on the index. And, of course, being a zero DTE day, and every day is a zero DTE day with the SPX or the NDX, that day is the day that weekly options contract is decaying at the fastest rate in the shortest period of time. And so that presents an opportunity to potentially at least garner some of that. Now, it's impossible to get it all the time. It's just not possible. And so instead, we want to try to come up with a way that is probabilistic, that will put us in the right place to give us the opportunity to grab the kind of profit that we're looking for or that may be presented to us. And it's not something that you can pull out every day. That is unrealistic. People that think that way think that you can actually create an income from trading. And when I say an income, as if there is an equal opportunity every day to pull out the same amount of money. Now, I know that there are some strategies out there that attempt to do this, but they don't really do it. And they have some real big problems. One is they have a scalability problem. And most of those strategies are built on market neutral strategies or high probability strategies, either using an at-the-money butterfly or a very low delta iron condor or something similar to that. And those are not scalable because their distribution of returns are all wrong. In order to scale or to have any appreciable returns, you need massive amounts of capital. And so for that reason, it's not scalable. I mean, if you want to scale, you want to be able to scale up with a small amount of capital with very large return. And so that's why you need that asymmetry that an out-of-the-money butterfly supplies. And quite frankly, this is really what most pro traders that I've ever seen trade. I mean, this is it. This is why they do it. Now, how they set up the trade is kind of interesting, marginally interesting, because they do it in such a way that doesn't require them to put a lot of thought into it. And they don't want to put a lot of thought into it. They just want to put these trades on. And sometimes one of these traders will put on a number of these, one right after the other, and trying it, and then manage each one of those coming in. But generally what we do is we just do one trade, one a day, and then try to manage that. And it's got a lot of flexibility into it. In other words, you can trade it with a very small account, you can trade it with a medium-sized account, you can trade it with a very large account, you can trade it with extreme volatility or very little volatility. Of course, each of those market types are going to give you a different result, and you have to adjust your trade to accommodate those market types. Now, the way most pro traders put one of these trades on is without regard to where they're putting it on. When you're on the trading floor, of course, you're going to do your research and figure out what type of energies are coming into the market reports, etc. Plus, when you're on the trading floor, you're also looking at the activity that's there, and so you can get a good feel for what's happening, what price action looks like, and you've got all the big boards there, and you can see everything that's happening. But it's not enough to give you any real advantage. And so the idea then is to put the trade on in a really agnostic way. And so what that means is that without regard to what the underlying market structure or the energies that are coming in, and then work on actually how you're going to manage the trade after it's been put on. Now, you also know that there's a certain setup that you want to do that's going to help you put the trade on, and they'll also give you kind of a sweet spot for collecting premium or for being successful in general. And that trade will adjust depending on what the underlying market structure is. And what do I mean by that? Well, I mean that when you have a very high volatility regime, like right now, we're in a super low volatility regime. The VIX is, well, where is the VIX? VIX is way down there. Now, this goes all the way back to the pandemic, and you can see there's the crash that we had there. And I have these two green lines that I consider the Goldilocks zone, and that's where maybe 95% of all trading occurs. And generally, I split it up when we're in that area. That's kind of normalcy for most markets. And I always want to know, are we in the top third, bottom third, or are we right in the heart of the Goldilocks zone? Now, this area that I've defined is also well known to other types of traders that were on the floor that are using similar strategy, or not the similar strategy to this, but are using strategies that are very common on the trade floor, like the orb or the open range breakout. And they won't trade anything unless it's in the top 2/3 of the market. Once you start getting down to the below a third or below a VIX of 17, the orb strategy is basically useless. But let's get back to the out-of-the-money butterfly. Now, the butterfly is an interesting strategy. It's largely considered Vega negative, and so we need to understand exactly what that means. Now, Vega negative means that if you had a butterfly, it benefits from falling volatility. And what I mean by benefit is that premium tends to decay faster or decay earlier. Now, there's nothing that can be done in terms of volatility or Vega that will affect premium that much once you start getting into the waning hours of the market. When you're in the last 2 hours of the market, there's virtually nothing that volatility can do to affect how fast or how slow premium is decaying. I mean, once that happens, it's like you're in the vortex, you're over the event horizon of a black hole, and it's going down. Time is the number one arbiter of how premium decays once you get to that part of the day. But in the beginning part of the day, there are a lot of things that can affect a butterfly in terms of volatility. When you have very, very high volatility, at least from a butterfly point of view, that will suppress the premium decay. It'll suppress it. Now, what it's really doing is it's loading up premium on the individual contracts, but it's giving you a greater opportunity to get into that fly if it's out of the money with a better price and more potential decay from then until the end of the day. Conversely, if volatility is very low, then that premium decay is kind of preloaded. It happens faster. And so the P&L curve inside of that same butterfly will already look like it's been decayed. As a matter of fact, in the morning, you can take a 20-wide butterfly on a day like today where volatility is very low, and it will look like it's already halfway decayed. Now, if you go, let's say, I don't know, back in February or March of this year when volatility was much higher, that same butterfly would have an absolutely flat P&L curve. It'll be flat, and there'll be plenty of room for it to decay over the day. So that's really the difference between one volatility regime over another.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.